First is safety, then is the liquidity, and then is the returns. We are into that rate cutting scenario, and that's a very opportune time income advantage FO, all weather debt product. We played that rising rate scenario pretty well.
Hello and welcome. I'm Ruchira and with me is Chirag. Today our guest is Aditya Pagaria. He's Senior Fund Manager Fixed Income at Axis Mutual Fund. Welcome, Aditya.
Thank you so much, Ruchira, for inviting me on this forum.
Good to have you here. Now, with rate cuts from the RBI and rising global yields creating fresh dynamics in the debt market, fixed income decisions have never been more critical. So, Aditya, let's begin from where it all started for you. So, you hold a PGDBM in finance. What attracted you to fixed income over equities?
So, when I started my career, in my ex-organization into the fund accounting department. So, it was more of fund accounting, more of evaluation of debt securities. So, equities was, not much of a valuation because you get ready-made prices from the exchange. But, for debt instruments that we handle like CPCDs, T-bills, more complex instrument like PTCs. So valuing those was a bit more challenging. So I had an interest towards them, learning more towards them, and finally I got an opportunity to work with the fixed income team, and there I started my career in 2012, and here I am now. Spending almost 13-14 years into fund management.
Aditya, with over 18 years of experience in the mutual fund industry, you have navigated major events like the global financial crisis, taper tantrum, and the COVID-19 crisis. What are the key lessons learned during those periods?
So actually, to be fair, I don't use the word crisis. I find it as an opportunity for the investors to make money out of crisis. So you have seen various crises in past 15 years, be it 2008 crisis, then 2013 taper tantrum, 2018 the credit crisis, and again 2020 COVID crisis. So if you see on the high side, investors have always made money, and the investors who have made money have always maintained discipline in their investments. So it is primarily you maintain your discipline, you maintain your asset allocation. So there are times when equity markets are good, your equity allocation increases, and timely you have to book profits and move to other asset classes. In today's times where asset classes like gold has outperformed massively in last 1 year, giving almost 40% type of returns. So people can use this opportunity to diversify something from gold to maybe equities, where we have seen sharp amount of correction. I personally use these crises as an opportunity to rebalance my asset allocation and maintain discipline on investing. So SIPs, don't stop SIPs at all during the crisis. Maintain healthy cash flows where you can use it for your goals in terms of crisis. So these are some kind of advice that investors should keep into mind.
Okay, now can you explain how do you pick debt instruments? What's your core strategy there?
So picking up debt instruments, it depends on what the fund mandates are, what SEBI has prescribed various fund mandates for different types of fixed income funds. So broadly, we take a macro call. It depends on the economic factors, the inflation, the global economy, how it is panning out, the growth, how it is panning out. More granular would be banking liquidity, how it is panning out. So depending on that view that we built in, broadly 80-85% of the portfolio is built in based on that view, and the rest 10-15% of the portfolio apart from that core portfolio is more of we use as an opportunistic way to generate alpha. Maybe in terms of fixed income, you might have times wherein certain credit spread expand. There is some dislocation in the curve where we find a good opportunity for the investors to make money. So we use at 5-10% of the core portfolio. So broadly, the core portfolio remains 80-85%. The rest of the portfolio, it depends on the market opportunities. It is more tactical in nature.
Okay, and is this process the same across all debt funds?
Yes, it is across. So macro view is taken, and then accordingly, depending on the fund mandates, we do build the core portfolio to the tune of 80-85%.
Right.
Now, Aditya, with the RBI cutting interest rates to spur growth amid the rising global yields, how do you see the Indian debt market at this point of time? Is it stable? Is it choppy? Or is it a full of opportunity?
Again, I would put it as a very good opportunity for the investors who are investing in fixed income. So typically, if you see this rate hike cycle or rate cut cycle, typically lasts for 1.5, or maximum 2 years. So we have seen a stable rate environment for last 1.5 years. Past 6 months, 3 months, we have seen two rate cuts. So we are into that rate cutting scenario, and that's a very uh, opportune time that we have started with the rate cut just now. I know investors who had entered at an opportune time, say 6-8 months back, they have made decent amount of returns in terms of debt portfolio. Broadly, all duration funds have given double-digit returns. But the story is not over yet. There is still the MPC right now that we have. It's more accommodative. It is more listening to what the market has to give them feedback. So in terms of that, we think rates cut cycle is not over. So there is obviously returns to be made more from this fixed income cycle. Uh, just to give you certain caveats, something like global economy is very volatile. The USD strengthening, or US 10-year yields going up, or strengthening of dollar or crude prices going up can be a deal breaker for this particular journey. But overall, we are quite positive on the fixed income front.
But Aditya, if we look at it in the as you mentioned, in the last 3 months, we have seen two rates cuts. Some people might feel, we have missed the bus because as the rates go down, the yields increases and the returns increases in debt instruments. So, what will you suggest to them? Do you see more of the rate cuts going forward, and of what quantum do you see the rate cuts?
See, market is currently pricing in roughly around 50 basis of rate cuts more in this particular rate cycle. Obviously, the kind of liquidity measures that RBI has taken, the impact on the rates have been much more. For example, just to give you some numbers, the kind of liquidity that RBI has given in past 4 months or so is to the tune of almost 8.5 lakh crores. So these kind of liquidity measures, in terms of, it's a mix of OMOs, FX swaps, long-term repos. These kind of liquidity measures have not been seen for a long time in India. So it is not that investors have missed the bus. There is still an opportune time. There are parts of the yield curve that are still attractive. So investors can get into this journey right now also, and have a very decent fixed income journey for next 1 year or so.
So do you see this as an opportunity to lock in higher yields?
Yes, obviously. Even if you see, for example, the current repo rate is at 6%, and because of most of the liquidity measures, the overnight rate is more of 5.75%. Still, your corporate bonds are available at 7 quarter handle. So there's a very decent amount of carry that investors can make in. Even if you take inflation roughly RBI has projected to be 4% for this financial year. Still, your GSEC is available close to 6.5. Corporate bonds are available at 7+ handle. So still, there is a huge difference between the real rates actually. So there is money to be made for fixed income in next 1 year or so. Investors should look at fixed income products pretty actively.
How do you balance this with the risks posed by rising global yields impacting domestic bond prices?
So as I told you, there is a caveat that there are many at one point in time there were taper tantrums. Now there are tariff tantrums actually. So it has been a quite volatile journey. But if you see Indian yields and US yield, the differential that used to be there a few years back, it was closer to 350, 375 basis point. It is now 200 basis points. So market is a bit jittery that what might happen if inflation comes back. What happens if the tariff becomes a serious game and it is not rolled back. Obviously, it is not a one-side journey. But the cushions that we have in terms of accommodative RBI, in terms of rate cuts, in terms of liquidity being provided, it is a very decent opportunity. Meanwhile, the liquidity in our portfolio is pretty decent. So there is any downturn, upturn in terms of yield in US or in India, our portfolios are there to churn the portfolio and cut the duration across in case anything goes wrong.
Aditya, now coming to one of the fund specific question which I wanted to ask, it's about the Axis Floater Fund, which has delivered the returns of 13% in the over the past year. And we have been told that this floater funds work well during the when the interest rates are going up. So could you just help us understand what are the key factors or decisions drove the strong performance?
So Chirag rightly said, the notion in the market is floating rate fund only works well in a rising interest rate scenario because you hold a lot of floating rate bonds in the portfolio. They cushion it when the rates rises. So in floating rate bonds, as the rate goes up, the prices also go up. That by cushioning the yields. But what the way we have positioned our floater fund, we played that rising rate scenario pretty well. When we thought that rates have peaked, now it's time for floating rate funds or the duration funds to rally. So we churned the portfolio in a way that we moved from fixed rate bonds to floating rate bonds to fixed rate bonds, thereby increasing the fund maturity. In terms of the term maturity for this particular fund was closer to 8 to 10 years in past 1 year or so. So thereby, it has captured the best of both the worlds. So rising rate scenario also, and in rates cut scenario also, the terms have been quite favorable for this particular fund, and we have hedged this particular portfolio with synthetic options so that the fund mandate remains a floating rate fund. So that is the reason of outperformance for this Axis floating rate fund.
Aditya, can you share with us how do you evaluate an issuer's creditworthiness in fixed income securities? Like, what are the red flags or metrics that matter the most, and how is that different from analyzing equities?
It's a very pertinent question in terms of investing into fixed income. People are very worried in terms of wherein there are credit crises that happen. So people are worried on what kind of due diligence we do in terms of selecting the credit and investing in that for a particular fund. So there are primarily three factors that we look at. First and foremost is how the promoter and the management is there. What is the leverage in that particular company? What is the sectoral view of that particular company? So these are the prime three factors that we look at. Apart from that, we see how the company is able to generate cash flows easily into the company, and what is the flexibility that the promoter has if anything goes wrong. How can he put money, or how how much money he can put into the company to get the company out of a crisis if anything happens. So these are primarily things we see before selecting any company for investments. Apart from that, what differentiates it from the equity investments is more of what we say, the covenants that we put while investing into the bond. So many times we put covenants like minimum promoter holding should be there to be say X percentage in a company till we are invested in the bond, or we put in rating covenants so that if the rating of this particular company falls below a certain threshold, then company has to pay back. Or it might be if the company's leverage again it goes above a certain threshold, then again obviously the company has to pay back the bond. So these are differentiating factor that we do for credit selection in terms of access philosophy.
Now, Aditya, in equity funds, if we look at it for investors, people suggest, you can go for a flexi cap fund, which has a mix of large cap, small cap, mid cap.
Yeah.
But with regards to debt fund, is there any particular category, which is a all-weather fund where investors can come in and stay invested for long duration and can exit wherever they need the money?
Again, a very good question. Very apt question. So SEBI has actually introduced a new category, that is income advantage FOF. So that's a very the latest category that SEBI has come in with. So what it does is, so it has 35% exposure to equity arbitrage funds, and that is the minimum investment required. And 65% is allocated to various debt funds. So it is kind of an FOF, which gives you stable returns in terms of investing into debt and equity. And any investors who has a time horizon of say 2 years or more, he can have a optimal returns in terms of taxation as compared to a fixed income plain vanilla scheme. So this income advantage category is something that investors can look at for as an all-weather debt product.
Okay. Right. Now, in the current economic mix, how should investors split money between equities, debt, and other asset classes? And what role should debt funds play in a balanced portfolio given the current economic environment?
See, again, asset allocation again depends on the individual's requirement, his goals, his age, his risk appetite. So there are many factors. So it can't be a single approach for asset allocation. But broadly, when it comes to fixed income acts as a cushion to your a mix of asset allocation. So equity at times has been volatile. It has given a returns of 15%, 20%. There have been years that they have been stable or given negative returns. But in case of fixed income, broadly, apart from the crisis years, broadly a 3 to 5 year return ranges between 6% to 10%. So that is the kind of cushion that fixed income products provide to your portfolio. So in case of any major volatility, if your asset allocation to fixed income goes up because of correction in say commodity prices or correction in equity prices, you can very well use your fixed income portion to increase their allocation to any other asset classes. So it acts beautifully to protect you from the downside. And meanwhile, if there is downside in other categories, you can use your fixed income allocation to allocate more money to any of the asset classes.
Sir, you had mentioned earlier some point, but could you elaborate it? Suppose RBI pauses the rate cut or the global yield suddenly jump. How are you positioning your portfolios to stay nimble?
A very pertinent question in these volatile times, actually. So if you look at across our debt funds, so any funds you pick across, broadly 80 to 85% of a portfolio is more of sovereign and AAA rated assets. So liquidity in terms of these assets is very easy to get in the market. So anytime then when the market turns or our view changes, it is pretty easy to change our portfolio. Reduce the duration by selling, AAA sovereign assets and churning the portfolio. Given the liquidity of the instruments that we hold, is pretty easy. So, in case of any unfortunate event that may lead to hardening of yields, these kind of liquid assets in the portfolio will help us to churn the portfolio and reduce the duration if required.
Okay, so one last question. Fixed income can feel daunting for retail investors. So, what's your simple advice on choosing and sticking with debt funds today in today's dynamic market?
So I understand, I mean, retail penetration in debt mutual funds is not pretty big in India. Uh, People are more bound to traditional instruments like maybe a bank FD or other traditional assets, actually, maybe insurance and etc. But when you look at fixed income schemes, there are the kind of liquidity and the safety that the fixed income products provide to the investors is phenomenal. For example, exiting in any traditional instruments, it is not easy. You have to pay a certain price to exit that particular instrument. But in case of debt instruments, your portfolio is more diversified, your portfolio is more safe, and in terms of liquidity, you can get liquidity the very next day. So, in terms of what philosophy we follow in Axis, that is SLR, first is safety, then is the liquidity, and then is the returns. So, these are something that investors should look at, and based on that, they can look at fixed income products across mutual funds.
Right. Well, thank you, Aditya, for sharing those valuable insights. It's been a pleasure speaking with you.
Thanks, Suchira. Thanks, Chirag. Pleasure
Thank you.
talking to you.